Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Welcome back to the Risk Intel podcast. I'm very excited to have a new guest here with me on the program today, Craig Hartman, who is the Chair and CEO of Plansmith. Craig, thanks very much for being with us today.
I'm looking forward to it. Sounds like a fun time.
Greg, when we were talking about topics to explore, we landed on this topic of execution risk, and you've spent your career in the kind of planning, forecasting, risk space, if you will, broadly speaking. So maybe before we jump into the topic of the day, you could share with the audience a little bit about your background. Right, you've worked with financial institutions for the majority of your career. I'd love to set the stage a little bit as to what's been your background.
Well, I'm probably the least likely person to be involved in financial planning. I'm an engineer by training. I actually went to work after I graduated for the Bureau of Reclamation in Colorado. Like most government agencies, they didn't have a lot to do, and so I found a time-sharing computer. This is back in the late 60s, and taught myself to program. And then I had worked in engineering for a while, and I had some problems I figured out how to solve. So after figuring some of those out, I decided to leave the Bureau, go back to work for a company I'd worked for back in Chicago, and started writing software for engineers to solve various problems. And decided in 1970 to start my own company to service that industry, engineers, architects, surveyors. So I started that, and that worked out fairly well. And I got approached by Computer Sciences Corporation to resell our software around the world. In the process, they had some guys who were selling services to businesses, and they wanted to know if I could write any kind of forecasting, sales forecasting stuff. Well, that's pretty simplistic, so sure, no problem. So we got involved in doing sales forecasting for these Fortune 500 companies, and out of that grew, well, can we do a budget? So we got into budgeting, and we ended up with quite a few big companies, and each one of them was unique, which was one of the difficulties, because you had to learn to understand each business and how it functions. And sometimes it was not so much budgeting, but more of an operations research to figure out how they built things and so forth. Anyway, I did that, and I moved into a bank building, bought a time-sharing computer, a digital PDP-10 or 11, moved into a bank building, and the chairman of that bank had a big data center, and he used to come up and we'd give it. And in my world, it was interactive. So you'd be able to put things in, get the answer back, print a report, so forth. So he was fascinated by that. So he coerced me, had a hell of a deal, to write a bank planning model, which I had no idea. I mean, I had a checking account. That was my extent of financial management,
Yeah.
So we did. And he had a 5-bank holding company. So I wrote this system, and I kind of over-engineered it. I assumed it would be more of a model. And it turns out what they were doing was paper spreadsheets. And all they wanted to do was duplicate that, which we used to call an input-output model. So the forecast was, I'm going to grow my loans $10 million, and you put that in, that was the plan. So we did that. And it started to become popular. And at the time, the difficulty was two things. We had to have, we were using teletypes as the input device for the modem. This is back in 1971. And we found out most people didn't know how to type. So run bank plan, where's the R? So we kind of overcame that. We started doing our own training. In some cases, we ran it for banks. Next challenge was to be able to get the data from their systems into our system. And then it got more complicated. We tried to get, maturity data and repricing data, and it evolved. And we were actually the first interactive bank planning system in the country, in the world, as far as I know.
Okay.
And that business grew. And so I ended up eventually getting out of the engineering business for a couple of reasons. One is you work for engineers and architects who are working for somebody else. It takes a while to get paid.
Not
which,
ideal.
which is difficult. We did that. We got rid of the engineering business. I finally ended up, took me 10 years to get rid of the corporate planning business because they were, these companies were all tied up with that. But we got heavily into the bank planning business and built a practice. And then, as you may remember, in the early 70s, mid 70s, the oil crisis hit and we were in big financial problems and everybody was trying to plan rates and what that's going to be. And back about that time, somebody invented the rate sensitivity gap. And it was an article. It was actually, the guy was an engineer and he was an accountant actually, worked for a bank in Boston and looked at his balance sheet and said, I think we have some interest rate here. Remember, the rates are going up and down like a yo-yo. He said, I think we have some interest rate risk here. And I think if we look at the maturities 3 months out for our loans and deposits and kind of figure out what would happen if rates went up or down, that would give us an idea of our risk. Well, that was, wow, what a concept. So the rate sensitivity gap took over. And simultaneously with that, microcomputers, the Apple came out and VisiCalc, and everybody was starting to use spreadsheets, electronic spreadsheets, to calculate their gap, which was relatively simple, but they made it a big project. And in 1981, I went to the first ABA or a banking group, I can't remember the name of, had a tech conference. And out of 85 exhibits, 80 of them were selling some form of gap analysis on some kind of a computer, a desktop. And that was crazy. But anyway, we kept building, and we got into savings and loans and some credit unions and so forth. Actually, the bank group I was involved with, because I was in their building, and I ended up becoming one of their board members. They started investing in gold, and we had all kinds of crazy stuff going on. But lost my train of thought there. But anyway, we just continued. Other competitors came into the field. IBM came out with the PC, and it just grew. Eventually, we got rid of our time-sharing computers and got rid of our large company business because it was just too complicated to keep track of all these different systems. And we just focus now on bank budgeting, planning, and interest rate risk. The regulators force a lot of that because people have to do interest rate risk and they really don't want to.
Right.
And the regulators, of course, come out with their methodologies. You've got to, they're very interested in a lot of rate shocks and stress testing and things like that. So that's what we've been doing it for 50 years, and we keep meeting the technology challenges coming along. It's kind of interesting to watch how we originally were, you phone in on a modem, and now you
Right.
get to the web, and nothing's changed. It just
Right. Just the way you get in, it's the way you get in that front door, right?
right. So anyway, that's the long and short of it. And
One
we've
of the
seen
things
a
that
lot
you
of banks and worked with a lot of banks and helped a lot of banks and seen some bad ideas and some good ideas. And
Yep. Well, you said something in there that really struck me, which was, right, you started talking about the number of different risks that a financial institution would be exposed to. And so it's clear, right, that over this, journey that you've been a part of, right, you've seen a lot. But one of the things that it sounds like you've seen is that there are often a number of different siloed risks. And our concept of enterprise risk management is that you want a holistic view. You have to look at all of those things. But regardless of what that risk is, you face the concept of execution risk, which is really all encompassing from liquidity, interest rate, right? Operational, strategic, right? Cyber security, right? But execution risk really is all encompassing.
Well, what all of those things are, everybody's busy identifying them. And we see that a lot. And as an
Right.
engineer, that's kind of the first step. But so many people think that that's the end. Okay, I identified my risk. But, and then they kind of give some thought about how to mitigate it. Um, and that I think is the rub. And I guess going back to my engineering background, it's to solve a problem, to figure out how to get from here to there and recognizing and identifying those risks. So all of the things that you guys do in risk in Watchtower with your various analyses, as far as I can see, you're identifying the risk and kind of quantifying it, and you've got this kind of risk in this area and that area. And we do the same thing with interest rate risk. We also do it with planning, and that's where the execution risk comes in. For a long time, and it's not even uncommon today, we see bankers struggling to do a budget. That's their thing. Every
Right.
year they get together and they gather information, and sometimes it takes 2 or 3 months. I don't know why, but it takes them 2 or 3 months to gather up all the facts. Then they'll meet with each individual department and get their forecast, which can be a momentum forecast, it can be a gut feel, it can be aspirational, whatever it is. They put that into the system and then they crunch it, and it comes out with a number. And if they like the number, that's it. And then, as we say, they do that and then they go back to work. Oh,
That's it. One and done.
this is what we're going to do next year. And I've sat on several boards, and every board meeting we give the variances and so forth, and then we get what I call the spin, why
Right.
why this didn't work or why that didn't work. And one of my best stories was I've got actually sort of sat on his board. This banker would always at the board meeting, he'd take his current position and he'd add his forecast and say, this is what we're going to do. Well, if he was really awful, I mean, the forecast had nothing to do with that. He didn't,
Right.
and so I said to him, this, you've got a system, I know, because it's my system. You can sit down and reforecast. And there was a philosophy that somebody said you never change the budget, which I think came from never change the goal, but it got translated back to never change the budget. And people would cringe if you thought about changing the budget. Well, this was about changing the budget, changing the plan and how you're going to get to the goal, or maybe having to change the goal because it's too aggressive or whatever. So I finally got him to give the board a total reforecast based on current conditions and what we saw coming. And he, at one point, one of the board members said, I think Bill wants to put you in a box and get you out of here. Because he just didn't like that idea. So we had a user group meeting. And he was there, and we were talking. I'm trying to talk about the benefits of reforecasting and massaging your budget as you go. And Bill said, "I'd like to say something." He said, "Craig sits on my board. He proposed this idea to me. I didn't like it, but because he's a board member, I have to respond." So I started doing that, and every month, my cashier and I would get our numbers in and figure out where we were, and then we reforecast. He said, that was probably the best thing that's ever happened to me. He said it really gave me control over what was going on. And that was really gratifying to know that. But still, we have trouble getting people to do that because so many times the budget is put at a level in the bank that's kind of just clerical.
Right. Right.
Molly, put together the bank, you put together this, and they'll get the CFO involved and he might direct some of these people, but he ultimately gets the results and then they decide if it's going to meet the goals that they want. And there's a lot of different ways to, don't get me wrong, there's a lot of banks that do it very well, and I'm not putting that down. But that's what I keep seeing, and I keep trying to figure out how to get them to buy into this active planning. Because I've told you, it's like driving a car. I mean, you've got your rearview mirror, you've got your dashboard, and then you've got what's happening in front of you, and you've got
Right, the
going
windshield, right?
along
Looking
curve.
through the windshield.
And
Yep.
you're constantly changing the budget, if you will. I mean, if
Right,
the road ends and it goes off a cliff, you're not going to keep going, right? So
right.
same kind of methodology in a planning system. And now we have the tools. It used to be difficult. Remember when you did
Right.
a paper spreadsheet to change that sucker was just horrible.
Yes, it was a little right,
What,
but
2 minutes?
right, we've evolved significantly. But it comes back to this, I'll say the starting point, which you laid out there, right? Which is you plan and then you execute. And there's typically a gap between those two things, right? Because the best laid plans are, right? Was it Mike Tyson who said you can have a plan until I punch you in the mouth, right? And so then things change, right? Then we see what you're really made of, and that's
Well,
and so that's execution risk, I think, right? In its kind of
the,
most fundamental form.
the best one I've heard of is from the military that says, no plan stands up to reality.
Right.
And
Great.
even though they do all these extensive planning, things change. And
Right.
so agility is, I think, the key to it, and execution planning is that event. When we get somebody to replan on a monthly or quarterly basis based on what's going on, they don't have to do a budget next year. They're doing it. It's a law. They don't just do
They're
it.
living it. Right.
They roll it on and roll it on. And so the planning is an ongoing process, not a point in time. The
Right.
old it was an Aristotle had the idea about Hercules or Achilles and the turtle. If if Herc if the turtle starts out ahead of him and Hercules goes halfway, the turtle has moved. Now he's got to go halfway. You never gets to the turtle because he's always
Yeah.
going halfway, and that's kind
Right.
of the problem. You've got to keep looking beyond and figuring out where that's going to take you.
Well, so that's one of the, right, we've talked about a few different types of execution risk, and we've talked about, operational shortcomings, or resource limitations. You're hitting on, the third one that we've talked about, which is poor planning, or lack of subsequent planning.
Well, what's a plan? I mean, a lot of people say they show you their budget. That's the plan. That's not the plan. That's the numbers that you'd like to get to. Underneath that is the plan, which is the execution, which covers all the things we just mentioned, resources and technology, all kinds of issues that go into making that plan work. And what you've got in your hand in a budget are goals.
Right.
And I love Napoleon Hill in his book Think and Grow Rich. He always said, uh, "Goals are dreams with deadlines." And so everything
Hmm.
you've got on that piece of paper is a dream. How is it going to work? And that keeps coming out and I see more of that as we get into, some of the banks they're really worried about, but they're busy with other things. And that's one of the difficulties. Everybody's busy with something else. And
Right. There's always a reason. There's the keep the lights on, the run the bank, right? The day jobs that everyone has.
yeah, exactly. And the people who actually review all this is the board. They get their variance analysis and they talk about it. But how much of that actually comes out of that meeting and gets executed is a whole different problem. And that is the core of what we try to get them to do is use the system in conjunction. It's like the steering wheel. Our system's like a steering wheel. You're constantly going to make course adjustments by seeing what's going on and see if you can figure it out. One of the interesting things we have is in our software, you can look at your risk some period out in the future, 3 months, 6 months, a year out, to see, is my plan putting me in a more difficult risk position, by what I'm
Right.
going to do. And hopefully, if you see a risk, you will adjust for it. It's very hard to get people to use that idea. You know, uh, what we get is the government, the regulators, they want you to do an instant rate shock, as though rates are going to jump up, 100 or 200 or 300 basis points or drop. And what's that risk? Well, that's really artificial. I mean, it gives you some stressing ideas, sure. But, and then my favorite is they want you to backtest it. Backtest what? This is theoretical. I don't know. Your variance analysis is kind of a backtest on your real plan. So there's a whole bunch of functions. I mean, it's not just it's the non-interest income and expenses as well. How do they plan? The resource planning. Do we have the people to do it? Is the marketing plan working or not working? There's a lot of questions, and it should be, you got to keep your thumb on it.
So those are great examples of, right, you talk about resourcing or operational failures there in as types of execution risk. I think that, right, you had identified, in some of our prior conversations, a handful of examples that, certainly folks who are listening to us could relate to, like a bank launching a new software system or a core conversion that's delayed due to, right, mismanagement or a vendor dependency, or a bank has a cost-cutting initiative that it's not clear who was supposed to do which pieces, and it was great when it was announced at 40,000-foot level, but if you don't have, right, the follow through at the micro level, you don't meet those execution targets, right? So there's execution risk in all of those activities. How would you, if I were to ask you to give us some examples of the impact of execution risk, what are the types of things that come to mind, like the consequences, if you will?
The most obvious sometimes is you're just not going to hit your goals, your income goals, or whatever you're going to do, your growth goals or something. You got budget overruns, and shareholders are dissatisfied because things aren't working to the board or whatever. And sometimes it leads to failures that people in the organization are a little depressed about. And sometimes they don't feel that they're communicating what the real problem is because somebody else is trying to cover over the problem. So if you don't execute well, it just leads to failure unless you're just plain lucky.
Right.
I don't know if you play golf or not, but my execution risk in golf, I know what to do. I've got everything figured out. I know what the goal is, and I hit it, and it goes someplace else. Yeah. No.
Yes.
So I didn't execute well. Something went wrong. And it's the same in an organization. I mean, you know what you want to do, but it's sometimes a higher. And the other missing factor is senior management requirement to do that. And
yes.
And my favorite story is this bank I wrote the system for was on the board, and the chairman, this is back in the late 70s, decided that precious metal, gold, silver, so forth, are going to skyrocket. So, and banks can buy gold and hold gold and silver. So he decides all the banks, at this point he had 7 banks, were all going to have the opportunity to buy gold and precious metals and then, save that. And so he presents this to these 7 bankers. He gives them this big plan about how this is going to work and how this is great it's going to be and how much money they're going to make. And he decides to take a vote. And all 7 of them said no. They didn't want to get involved. They didn't understand.
Oh my. Uh-oh.
So he said, okay, I'm going to go through this one more time. He said, then we're going to take a vote. And I don't want it to be the 7-1 vote where the ones win.
So you have an opportunity to get on the right side of this vote.
So what happened? They all invested in gold, and in the early 80s, they sold it in the futures market and made a friggin' fortune. But none of those presidents, it was just outside of their wheelhouse to think about buying gold and silver and so forth. But they did, and it worked out well. But the 7-1 votes is one of the things I always think about. It comes from the top, then it will start to get done. Sometimes these kinds of things are mushy and down at the lower levels, and they're not really executed because.
Well, you're talking. I think you're highlighting there a key distinction between strategic risk and execution risk, right? The first part is the decision, right, that we're going to think about investing in gold, or that I'm going to hit my tee shot, right, to the right or to the left, right? That you start with your strategic plan, right? Certainly our audience is very familiar with that, right? You've seen a number of strategic plans. We have strategic plans for our businesses, right? So there's some risk in picking the wrong strategy. But if you get that right, you still then have this subsequent risk of executing against that strategic plan. So you've got to pick where you're going to hit the ball, or that you're going to invest in gold, but then you've got to actually follow through and do it.
Even your tactical plans require
Right.
that kind of attention. You know, I
Right.
mean, it's across, as we said in the beginning, it's an umbrella for every kind of potential risk. Is everything you're doing is leading to your actions.
I think that's a great capstone comment, and I'm going to kind of bring us to a close on this episode, and I'd like to come back and talk about then how do you mitigate from here. But I thought that your observation there, Craig, at the end, that really execution is an umbrella that's over all types of risks, right? All of those elements that we talked about, operational, liquidity, interest rate, resource limitations, port planning, all of that. Those are all elements that fall underneath this umbrella of execution risk. So it feels like the kind of the first step is acknowledging that execution risk exists, and it's something that we all have to deal with. And I think in our next episode, I'd love to unpack this question of, all right, if you now acknowledge that, what are you going to do about it? How do you mitigate? Where do you go from here? So thank you, Craig, for these thoughts on execution risk. A great jumping off point.
Good. Thank you. Enjoyed it.